Hear me out. Most people will ignore this until it is too late, even though it is one of the biggest financial choices of their entire life. I am Warren Buffett, and I have been doing this for over 40 years through BlackMonday.com, 2008, and COVID. I have watched systems look stable right up until they are not. Today is about pattern recognition and preparation, not panic. Imagine this scenario: you wake up one morning, you open your bank app, and there is a notice from your bank. Effective immediately withdrawals are limited. ATMs are capped at 300 per Dalton wire transfers, now require 5 to 7 business days of review. Online transfers to external accounts are temporarily suspended pending regulatory guidance. Your first reaction is panic. Of course, your second reaction is confusion. And your third reaction, if you are like most Americans, is complete helplessness because you have no plan. You never thought this could actually happen here, not in America, not to you. Let me tell you something: that is exactly what the British people thought in 1992. Over time, small leaks turn into large losses if you ignore them. That is exactly what the Argentinian people thought in 2001. That is exactly what the Cyprus people thought in 2013. And every single one of them was wrong. And by the time they realized they were wrong, it was already too late to do anything about it. So today I am going to walk you through exactly what bank withdrawal restrictions are, why they happen, what the specific warning signs look like before they hit, and most importantly, the exact steps you need to take right now today before any of this unfolds to protect yourself and your family. Not after, not when the news breaks right now, because by the time it makes headline news, the window to act is already closed. Let me start with something that happened in Cyprus in March 2013, because most Americans have completely forgotten about this. And that forgetting is dangerous. The Republic of Cyprus had two major banks. The Bank of Cyprus and Laiki Bank both were absolutely enormous relative to the size of the Cypriot economy. Both were deeply exposed to Greek government bonds. When Greece had its debt crisis, those bonds collapsed in value, and suddenly both Cypriot banks were insolvent, not struggling, not having a tough quarter, insolvent. The money was gone. The European Union and the International Monetary Fund stepped in with a bailout package. But there was a condition attached to that bailout that shocked the entire financial world. Depositors with more than 100,000 euros in their accounts would have a percentage of their deposits seized, literally confiscated, to help fund the bailout. And while the negotiations were happening before any of this was publicly announced, the Cypriot government did something that most people in that country had never imagined possible. They closed the banks completely for nearly 2 weeks. The banks simply did not open. ATMs were running dry. People could not access their own money. And when the banks finally reopened, withdrawal limits were imposed. People could only take out a few hundred euros per Dalton Y from their own accounts. Now here is what I want you to really understand about Cyprus. This did not happen because Cyprus was some poorly run banana republic. It happened because a sophisticated modern European banking system became insolvent almost. In my world, the first job is to avoid permanent loss overnight due to an interconnected chain of events. And the government's response, the moment things got bad enough, was to restrict access to people's own money, not to protect the depositors, to protect the system. Remember that phrase, to protect the system, because that is always the reason, and it will always be the reason. When a government or a central bank restricts your ability to withdraw your own money, they will tell you it is temporary. They will tell you it is to prevent fear. They will tell you it is to protect financial stability. What they will not tell you is that the system they are protecting is not your savings account. It is the plumbing of banking itself, which at that point has already failed. Now let me bring this closer to home. I want to talk about what happened with Silicon Valley Bank in March 2023, because the speed of that collapse should terrify every single person watching this video. Silicon Valley Bank was not a tiny community bank. It was the 16th largest bank in the United States. It had $209 billion in assets. It served thousands of technology companies, venture capital firms, and startups across the entire country. And it collapsed in 48 hours, not 48 weeks, not 48 days, 48 hours. Here is what happened. SVB had taken depositor money and invested heavily in long-term government bonds when interest rates were near zero. When the Federal Reserve raised interest rates aggressively starting in 2022, those bonds lost significant value. SVB was sitting on enormous unrealized losses. when word started spreading in the venture capital community through text messages. And Twitter posts a bank run started depositors tried to pull out $42 billion. In a single day, the bank could not meet those withdrawal demands. It failed. The FDIC stepped in and took it over. Now, the federal government ultimately guaranteed all deposits in that specific case. But I want you to think about something very carefully. The guarantee only came after the failure. After the panic, after the bank run, if you had money in Silicon Valley Bank and you were not plugged into the right networks, if you did not have friends in venture capital sending, you frantic text messages on Thursday afternoon, if you were just a regular business owner with your operating account sitting there, you woke up Friday morning to find that your bank no longer existed. You could not access your money. You did not know if you would ever see it again. That is not a third world problem. That happened in California in 2023, and the conditions that caused it have not been fixed. They have gotten significantly worse. Let me explain why. When Silicon Valley Bank failed, everyone focused on the specific details: bad bond investments, concentrated depositor-based social media, accelerated bank run. But they missed the bigger picture. SVB was a symptom of a systemic problem that affects virtually every bank in the United States right now. And that problem is this: the Federal Reserve raised interest rates faster and higher than any time in 40 years. Every bank that bought long-term bonds or made long-term loans during the era of near zero rates is sitting on unrealized losses. The total unrealized losses across the entire U.S. banking system are estimated at somewhere between $600 billion and $700 billion. That is not a rounding error. That is an existential threat to the stability of the banking system, and almost none of it has been recognized yet on the balance sheets of these banks, because accounting rules allow them to classify those bonds as held to maturity and not mark them to market. You do not need panic. You need preparation and arithmetic. In other words, the losses are real, but they are hidden for now. Now I need you to understand something fundamental about how banks actually work, because most people do not really know this, and not knowing it is going to hurt them. When you deposit money in a bank, that money does not just sit in a vault with your name on it. Incentives explain a lot of behavior in finance. The bank takes your deposit and uses it to make loans and investments under the current fractional reserve system. Banks are only required to keep a small fraction of deposits on hand at any given time. The rest is deployed. This works fine as long as not too many people try to withdraw money at the same time. The moment that changes, the moment trust breaks and people start rushing to get their money out. The bank cannot meet those demands. That is a bank run. And then once a bank run starts, it is almost impossible to stop without outside intervention. Here is what makes the current situation uniquely dangerous. Bank runs used to take weeks to develop. People would hear rumors, they would get nervous, they would go to the branch and stand in line to withdraw money. That physical process gave banks time to respond, time for regulators to step in, time for confidence to be restored. That is not how bank runs work anymore. Today, a bank run happens at the speed of a text message. It happens on Twitter and Reddit, and in group chats. It happens when a single influential investor sends a message to his portfolio company saying, "Get your money out right now." And within hours, billions of dollars are leaving the bank through digital transfers before any human regulator can even respond. The damage is done. Silicon Valley Bank lost $42 billion in withdrawal requests in a single day. The entire run was organized and executed through digital channels in a matter of hours. The next bank that fails will probably go even faster, and the one after that even faster still. We have fundamentally changed the dynamics of bank runs, but we have not changed the underlying fragility of the banking system. A margin of safety is not a slogan. It is a plan. That is a very dangerous combination. So let me now tell you exactly what to watch for. These are the specific early warning signs that bank limits could be coming, and they will appear before any official announcement is made. Watch this carefully, because these signals will only be visible for a brief window before the opportunity to act closes entirely. The first warning sign is deposit outflows at regional banks. When you start seeing news reports about significant deposit outflows from regional and mid-sized banks, when you start hearing about banks quietly raising their CD rates dramatically to attract deposits, when you see bank stocks declining sharply while the broader market is holding steady, something is wrong underneath the surface. In the months before Silicon Valley Bank collapsed, there were people paying very close attention who could see the deposit flight beginning. Most people were not paying attention. Do not be most people. The second warning sign is credit markets freezing up. Watch the spreads between investment-grade bonds and junk bonds. Watch whether companies are successfully issuing new debt or whether bond offerings are being pulled. Watch whether banks are tightening lending standards. When credit markets start seizing, it means money is becoming afraid. In my world, the first job is to avoid permanent loss, and money that is afraid eventually runs to safety, which pulls it away from the banks that need it most. Over time, small leaks turn into large losses if you ignore them. The third warning sign is the Federal Reserve starting emergency liquidity operations, when the Fed starts creating new emergency lending facilities, when they start allowing banks to borrow against assets at par value rather than market value. That is a massive red flag. They did exactly this in March 2023 with the Bank Term Funding Program. It was essentially a quiet acknowledgement that parts of the plumbing of banking were under severe stress. Most people ignored it entirely. Do not ignore it. This time, the fourth warning sign is politicians and regulators telling you everything is fine. I mean this with complete seriousness when the Treasury Secretary holds a press conference to tell you that the plumbing of banking is sound. That is not reassurance. That is a signal. In the 2nd of March, 008 Bear Street, Ern's CEO Alan Schwartz went on television and said his firm's liquidity position was fine. The company collapsed within 72 hours. Officials do not hold press conferences to tell you things are fine when things actually are fine. They hold those press conferences when things are starting to break. And they need to slow the panic. The fifth and most important warning sign is stories about large institutional depositors quietly moving money. Over time, small leaks turn into large losses if you ignore them. When hedge funds, large corporations, and sophisticated investors start moving significant deposits out of certain banks or out of the banking system altogether, they know something they always move first by the time you read about it in the news. Those sophisticated investors have already acted. Your job is to be one of the people who acts early, not one of the people who reads about it afterward. Now I want to talk about history again, because history is the only reliable teacher we have in finance. In 2001, Argentina experienced one of the worst financial crises of any modern economy. The Argentine peso was pegged to the US dollar. The government had accumulated massive debt, and the economy was contracting sharply. Sound familiar? When it became clear that Argentina could not maintain the peg and might default on its debt, Argentines began rushing to convert their pesos into dollars and to withdraw cash from banks. The government's response in December 2001 was called the Corralito. It means the little fence. They restricted bank withdrawals to 250 pesos per week. They banned the transfer of money abroad. They essentially locked people inside the financial system with no way out. People who had their savings in the bank watched helplessly as the currency was devalued by 70%. The purchasing power of their life savings was destroyed while their money was locked up inside a system they could not escape. The Argentines who survived with their wealth intact were the ones who had already moved assets before the Corralito. They had already converted pesos to dollars. They had already moved money offshore. They had already bought real estate or gold or other stores of value by the time the restrictions hit. They were already positioned. Everyone else lost most of what they had. I am not telling you that America is Argentina. I am not predicting a currency collapse or a 70% devaluation of the dollar. What I am telling you is that the mechanism, the specific series of events through which governments restrict access to money when financial systems are under stress, is not unique to Argentina or Cyprus or any other country you might consider less stable than America. It is a universal response to banking system stress and the conditions for banking system stress in America today are more pronounced than at any point I can remember in my career. So let me now get to the most important part of this entire conversation. What do you actually do? If you are sitting there watching this video and you are starting to feel that uncomfortable mix of concern and urgency, good. You do not need, you need preparation and arithmetic. that feeling is appropriate, channel it into action here, is exactly what I would do step by step if I were a regular investor trying to protect myself from bank withdrawal restrictions. Step 1 is diversify your banking relationships immediately. If you have all of your money in one bank, you are taking a downside risk. You do not need to spread your deposits across multiple institutions. And I want to be very specific here. Do not just open accounts at 3 different branches of the same bank. That does not help you. If your bank restricts withdrawals, it restricts them everywhere. You need accounts at genuinely different institutions. Consider having accounts at a large national bank, a credit union, and a separate online bank, different regulatory structures, different balance sheet exposures, different downside risk profiles. If one has a problem, you are not completely frozen. Step 2 is understand the FDIC insurance limits and position yourself within them. FDIC insurance covers up to $250,000 per depositor per institution. If you have more than 250 zeros in yours at any single bank, you need to restructure your accounts. You can increase your effective FDIC coverage significantly through proper account titling, using joint accounts, retirement accounts. Incentives explain a lot of behavior in finance and trusts, but you have to do this before a crisis, not during a crisis. The rules can change and your ability to restructure is dramatically reduced. Step 3 is maintain a meaningful cash reserve outside the plumbing of banking. I know this sounds extreme to some people. I know the financial planning textbooks say keep everything in the bank or invested. But physical cash serves a specific purpose that no bank account can serve if banks restrict digital transfers. And ATM withdrawals, physical cash is still universally accepted. How much? Enough to cover 3 to 6 months of essential living expenses, rent or mortgage, food, utilities, gasoline, medications. Keep it in a secure location in your home, not under your mattress, but in a proper safe. This is not paranoia. This is the same kind of emergency preparedness that sensible people apply to food storage, water, and generators. Step 4 is own physical gold, not gold ETFs, not gold mining stocks, not futures contracts, physical gold in your possession. I want to explain why this distinction matters so much. A gold ETF is a financial instrument. That represents a claim on gold in a genuine financial crisis. Financial instruments can fail, can be frozen, can be subject to emergency regulations. Physical gold that you hold in your hands cannot be frozen by a bank. It cannot be restricted by a government executive order in the same way a bank account can be restricted for 5,000 years. Across every financial crisis in human history, physical gold has maintained value. When paper currencies and financial systems have failed, it is the ultimate insurance policy. Now, I am not telling you to put everything in gold. That would be foolish. I am telling you to have a meaningful allocation, perhaps 5 to 10% of your net worth in physical precious metals that are in your direct possession, not in a bank safe deposit box. Because if the bank restricts access, you cannot get to your safe deposit box either. In my world, the first job is to avoid permanent loss in your possession in a secure location that you control. Step 5 is reduce your dependence on a single financial institution for critical life functions. Most Americans have their paycheck direct deposited to one bank. Their mortgage auto-paid from that same bank, their utilities auto-paid from that same bank, their credit cards linked to that same bank. They are completely dependent on the uninterrupted functioning of a single institution. When that institution has a problem, their entire financial life is disrupted. Diversify your financial plumbing, have backup payment methods, have a credit card from a different institution, have a checking account at a different bank that could receive income if needed. Reduce your single points of failure. Step 6. You do not need fear. You need preparation and arithmetic. And this is the one that most people will resist the most. Consider some exposure to assets outside the traditional banking and financial system. Real estate that you own free and clear is an asset that cannot be frozen by a bank. A small business with revenue generating cash is an asset that does not depend on financial system stability skills. And professional relationships are assets. These things do not show up on a brokerage statement, but in a genuine financial disruption, they are often more valuable than the numbers on your screen. Now I want to address something directly, because I know what some of you are thinking. You are thinking this sounds like the kind of stuff they talk about on extreme prepper channels. You might assume this is only for sophisticated traders. I am talking about everyday savers. Because the margin of safety is having access when everyone else is reaching for the exit. Let me be very clear about why I am making these specific recommendations right now, in 2026, in a way I would not have made them 5 years ago. Over time, small leaks turn into large losses if you ignore them. The combination of factors we are facing today is genuinely unprecedented in the modern era. We have a banking system sitting on hundreds of billions of dollars in unrealized losses. We have a federal government with $36 trillion in debt that is increasing by roughly $2,000 billion per year. We have interest costs on that debt that now exceed the entire defense budget. We have a Federal Reserve that is trapped between fighting inflation and not breaking the financial system. We have geopolitical tensions that are disrupting global trade and supply chains. We have digital bank-run technology that can collapse a major financial institution in 48 hours, and we have a generation of investors and depositors who have never experienced a genuine financial system disruption, and therefore do not believe one is possible. That last point is perhaps the most dangerous. The people who got hurt worst in 2008 were not the people who were paying attention to warning signs. They were the people who had been told for decades that the system was stable. You do not need panic. You need preparation and arithmetic. That real estate only goes up 1, that major banks do not fail 2, that the government will always be there to protect depositors. They were the people who had no framework for understanding that these things can and do happen. By the time they realized the framework was wrong, it was too late to act. I have lived through enough cycles to know that the phrase "this time is different" is almost always wrong, except when it is not. A margin of safety is not a slogan. It is a plan. The specific mechanism that provides the escape hatch in every previous crisis, the Fed's ability to slash rates to zero and print unlimited money, is genuinely compromised this time. Because if the Fed cuts rates aggressively, inflation comes roaring back. Because if the Fed prints aggressively, the dollar weakens dangerously. The pressure relief valve that has worked every time since 198, the 7th of May, not work. That time of margin of safety is not a slogan. It is a plan. And if it does not work, the consequences for ordinary depositors, ordinary savers, ordinary people who have done everything right, their whole lives could be severe. You might assume this is only for sophisticated traders. I am talking about everyday savers, because the margin of safety is having access when everyone else is reaching for the exit. You have been cautious before and been early. How do I know this time is not just another false alarm fare question? And my answer is this: the cost of taking defensive action early is very low. If I am wrong, if the banking system holds together, if the Fed manages this perfectly, if everything works out better than I expect, then what have you lost by spreading your deposits across multiple banks? Nothing. What have you lost by keeping 3 months of cash at home? You have foregone some interest. What have you lost by owning some physical gold, maybe some opportunity cost, if gold underperforms stocks? These are modest costs, inconveniences, adjustments. The cost of not acting, if I am right, is a completely different calculation. If bank withdrawal restrictions are imposed and you are completely unprepared, if you have 100% of your liquid assets locked inside the plumbing of banking, and you cannot access them, the consequences are not inconvenient, they are potentially catastrophic. You cannot pay your mortgage, you cannot buy groceries, you cannot cover a medical emergency, your business cannot meet payroll. The asymmetry here is enormous. The cost of being wrong and being prepared is low. The cost of being wrong and being unprepared is catastrophic. That asymmetry alone justifies taking defensive action. Over time, small leaks turn into large losses if you ignore them. Now I want to spend some time on something that I think is equally important, but gets far less attention. What do you do in the immediate moment if bank limits are actually announced? Because if that moment comes, the decisions you make in the first 24 to 48 hours will matter enormously. The first thing you do is stay calm. I mean that with complete sincerity. Fear is your worst enemy in a financial crisis. Fear leads to bad decisions. It leads to selling assets at the worst possible prices, it leads to making moves that create unnecessary losses. The people who do best in financial crises are almost always the ones who have a plan and execute it calmly, not the ones who react emotionally. The second thing you do is execute your predetermined plan, not improvise. This is why having a plan before the crisis matters so much. If you have already thought through your contingencies, if you already have physical cash, if you already have gold, if you already have accounts at multiple institutions, then when restrictions are announced, you do not need to figure out what to do. You have already done the work. You simply execute. The third thing you do is resist the urge to make dramatic, irreversible moves based on incomplete information. In the first hours and days of a financial announcement, the information is always incomplete and often wrong. The rumor mill works overtime. People make decisions based on information that later turns out to be false. Wait until you have clarity on what the restrictions actually are, what they actually cover, what the timeline actually looks like, then make measured, deliberate decisions. The fourth thing you do is focus on your essential needs. First, what do you absolutely need in the next 30 days? Food, shelter, utilities. Medication, make sure those needs can be met using whatever resources are available to you outside the restricted system. Then think about medium-term and long-term positioning once the immediate needs are covered. The fifth thing, and I cannot emphasize this enough, do not try to be a hero. Do not try to time the crisis perfectly. Do not try to make a killing while everyone else is panicking. I have seen people try to do this and get destroyed. The primary objective in a financial crisis is to preserve capital and maintain liquidity. The secondary objective is to position for recovery, trying to get rich during the acute phase of a crisis. Usually ends in disaster. Stay defensive, stay liquid, stay patient. The opportunities to profit come after the acute phase passes, not during it. Let me talk now about something that I think is deeply important and that nobody in mainstream finance wants to discuss: the social and political context of bank withdrawal restrictions. Because these things do not happen in a vacuum, they happen in a specific social and political environment. And that environment shapes everything about what the restrictions look like, how long they last, and what comes after. When governments impose bank withdrawal restrictions, they are making an extraordinarily difficult political calculation. They are choosing between two catastrophic options. Option one is let the banking system continue to function normally and risk a cascade of bank failures. That destroys depositor trust completely. Option two is restrict access temporarily. Prevent the cascading failures, accepting that you are going to create enormous anger and fear among the population. Governments almost always choose option two. They restrict access. They tell the public it is temporary. They say it is necessary to protect financial stability. And then they try to resolve the underlying banking system problems as quickly as possible, so they can lift the restrictions. Sometimes this works. Cyprus imposed restrictions and eventually lifted them. Sometimes it does not work. Argentina's restrictions led to currency collapse and economic depression. What determines which outcome? You get two things. First, whether the underlying banking system problems are actually solvable. Second, whether the government and central bank have the policy tools and credibility to solve them. This brings me back to the point I made earlier about the Federal Reserve being trapped. If bank restrictions were imposed in America today, the Fed's ability to quickly resolve the underlying issues would be severely constrained by the inflation situation. They cannot cut rates to zero to rescue banks, because that would reignite inflation. They cannot print unlimited money to recapitalize banks, because that would devalue the dollar and potentially trigger a currency crisis. In my world, the first job is to avoid permanent loss. The options available to them are significantly worse than the options they had in 2008. And the options they had in 2008 were already quite painful. I want to be transparent with you about something. I am not certain these things will happen. I want to be very clear about that. I have been in this business long enough to have enormous humility about specific predictions and specific timing. What I am certain about is this: the conditions that make these things possible have never been more pronounced in my career. The fragility of the banking system, the constraints on the Fed's ability to respond, The speed at which bank runs can now develop in the digital age, the political polarization that makes coordinated crisis response more difficult, all of these factors are at levels I have never seen simultaneously before. That does not mean crisis is certain. It means the downside risk of crisis is at a level that justifies serious defensive preparation. The people who tell you not to worry about this, who tell you the system is sound, who tell you the government will always protect depositors, those people are not necessarily wrong about the ultimate outcome. The government may well find a way through this without depositor restrictions, but they are completely wrong to suggest that. The downside risk is zero or even close to zero. The downside risk is real. The downside risk is higher than it has been in decades. And the asymmetry between the cost of preparation and the cost of being unprepared demands that you take it seriously. So let me summarize exactly what I am recommending. I want to make this as clear and actionable as possible, because I know that most people will watch a video like this and feel concerned in the moment, and then go back to their normal routine without doing anything. Do not be that person. What I am describing is not complicated. It does not require sophisticated financial knowledge. It requires deliberate action taken now. Before the moment of crisis arrives, open accounts at multiple genuinely different banking institutions. Make sure your deposits are structured to be fully within FDIC insurance limits. Establish a meaningful physical cash reserve covering 3 to 6 months of essential expenses. Stored securely in your possession, purchase physical gold and silver in amounts appropriate to your net worth, perhaps 5 to 10%, and store it in your direct possession in a secure location you control. Diversify your financial plumbing so that you are not completely dependent on a single institution for bill payments, income receipts, and essential transactions. Reduce leverage. In a liquidity crisis, debt kills. If you have significant margin debt or other financial leverage, reduce it now while markets are still relatively calm. And finally, have a plan, a written specific plan for what you will do. If restrictions are announced, not a vague intention, an actual plan with specific steps and specific resources identified. None of this is extreme. All of it is prudent. And all of it is significantly easier to do today than it will be if and when a crisis actually unfolds. I want to close with something personal. I have spent 40 years in this business. I have made a great deal of money. I have also made mistakes, been early, been wrong, paid the price for being overconfident about timing. But through all of it, the single most important principle I have operated by is this: capital preservation comes first, always not. Because growing wealth is not important. Of course it is important. But because you can only grow wealth if you still have capital to grow wealth that is destroyed in a crisis, cannot grow opportunities that are missed. Because you are financially paralyzed during a crisis, cannot be. Recovered. The investors I have watched get destroyed over 40 years were almost never destroyed. Because they lacked intelligence or market insight, they were destroyed because they underestimated downside risk and were unprepared when that risk materialized. The investors I have watched build lasting wealth were almost always people who understood that survival is the prerequisite to success. You cannot profit from the opportunities that crises create if you did not survive the crisis. I am telling you all of this because the setup I see right now tells me that the probability of a significant banking system disruption in the next 18 to 24 months is higher than I have ever seen it in 40 years of managing money. I could be wrong about the timing. I have been wrong about timing before. But I am not wrong about the direction of risk. The risk is real. A margin of safety is not a slogan. It is a plan. The fragility is real. And the time to prepare is before the moment of crisis, not during it. Take this seriously, do the work, make the changes, and whatever happens, you will be better positioned than the vast majority of people who are watching. You do not need fear. The same conditions unfold, and assuming that because things have been fine before, things will be fine this time. Too, they said the same thing in Cyprus. They said the same thing in Argentina. They said the same thing in 2007, right before the whole system broke. Do not be the person who said it this time. You do not need perfect timing. You need a margin of safety you can live with. Take one step today, then take the next step tomorrow, and do not wait for the panic to make the decision for you. Subscribe if you want more analysis like this, and tell me what you are watching right now. The window to prepare is open. Use it before it closes.